So what a currency index is pretty much, it's a general outlook on a currency's strength. So the DXY is the US dollar's currency index. So over time, this is on a weekly scale. You can see where the dollar's index has moved to, and you can use this in relation to other pairs. So let's say you're trading USD JPY, so the dollar versus the yen. You can then go to the yen's currency index and see how that is at a point on the graph and how that should react in comparison to your other pair, which would be the US dollar. And for example, I was doing, what was I doing? I was looking at the CAD, and so yeah, I'm expecting a big breakout out of here. I mean, this might take a month, 2 months to do, but I'm definitely expecting a big breakout coming out of this formation with a structured move that resembles this. So I'm looking for it to move $6. I don't really know how you measure that. It's not pips because it's a currency index, but I'm expecting to see it to make a structured move back to this high. Maybe definitely going to see some resistance in this area, because this definitely is an area of interest that you want to be looking at. But since I'm expecting it to make a structured move, and what a structured move is it resembles and moves the exact same on how it got into that formation. So this move from here out of this wedge, or out of this triangle formation, I'm expecting the same move to happen when we break out of this to bring us back to this high. Then where it's going to, what it's going to do from there, I don't know. So, I mean, but that's going to be what, like a year down the road that's going to happen? Yeah, half a year down the road, 6 months. So that's one thing that I want you guys to kind of start looking at, is the currency index. And like I said, for, let's say, CAD JPY, I'm looking at the CAD to get stronger and the yen to get weaker. And I mean, look at this. This is picture perfect in relation to a move. I mean, we can drop down to the daily to see what it's doing. And we're even getting this macro M. And when I mean macro, I mean on a higher time frame. I mean the daily, the weekly, the monthly. So when we're looking at this, you can clearly see a nice move to the M formation. This is also called a double top sometimes. But since it is in this level of interest, or as I like to say, a key level major reversal area, I'm still kind of learning about the currency indexes. I don't want to say that this is an institution level, but you can clearly see that every time price comes up here, besides this point, but this kind of made a head and shoulders, but every time price comes up here, you can clearly see a relation to price getting pushed back down. And comparing it with the CAD, you can see that there might just be a big move to the upside. So if the CAD gets strong and the yen gets weak in relation to their currency indexes, you can definitely see that the CAD JPY, if the CAD's getting strong and the yen's getting weak, CAD JPY is going to be moving upwards over the next 6 months potentially. Maybe meeting this high, maybe meeting up here. I don't really know yet. I'm still kind of figuring this out, but I wanted to relay this information onto you guys because I know it's very powerful. I know this is what banks and institutions are using. I know this is what the top traders that I follow are using because they trade in institutional style. So what that means is they trade with the smart money. They're trading the major moves. They're trading with the banks instead of with the retail traders. So something that I've recently learned, this is kind of off my script that I have, but something that I've recently learned is banks will trick retail traders into thinking the market's going one way, and it's going to actually go the opposite way. So what this will look like is, ironically, it looks like a flag. So the market will be moving upwards, clear uptrend, but then they'll push the market back this way, where we get some sort of consolidation area, here, where retail traders are going short to expect this break back down. But then banks push it back up. So that's something that I've kind of learned. And when this happens, is those false moves will happen during Asian session. Because in Asian session, the highest area of liquidity in sessions are New York session and London session. So if you were a bank, would you want to take your customers' money and move it the most when they're sleeping during Asian session, then have it back to the bank account by the time they wake up? Yeah, you're going to. And you can see examples of this. I believe GBP USD did it just recently. So what this will also look like is you'll see a trend going this way, but at, what time was it? Give me 1 second. I have it in my notes. So for false moves and breaks, the Asian session is considered the false move. The Asian session will move opposite of the trend, and then the London session that follows the Asian session will move with the trend. London has the highest liquidity. So if we're bullish on the Asian session, we're going to be bearish on the London session, because they're trying to trick retail traders into thinking it's going bullish. Then when London session happens and when all the liquidity pours into the market through the banks and institutions, they're going to push it back down bearish. And when this happens is from 8 p.m. to 12 a.m. Eastern Standard Time. So you can actually stick vertical lines on your chart and see this happen. So from 8 p.m., so that's 18 to 00. 18, this is 00. Oh, shit. 00 to 18. God damn it. Close enough. So in this area, I mean, this is over a longer time frame, but they're pushing this market down to then, soon as London hits at 1, 2 a.m., I believe it starts at 3 a.m., but they will then push this market up during London session. And they've already made all their money in this move right here of 50, 60 pips. And to a bank, that could be millions and billions of dollars that they just made by pushing the market down during the lowest time of liquidity, then pushing it up when it has the highest. And this kind of also ties into order blocks, which I'm going to now get into. To wrap up currency indexes, these are all the currency indexes. We have the yen as JXY, we have the dollar as DXY, Canadian dollar, euro, British pound, pretty much all the majors, even the Swiss franc. They all have their own currency indexes. So when I'm doing my markups, I'm looking at the daily, the weekly, and the monthly, specifically for these. Because with the currency indexes, you want to see the whole macro perspective of the whole trend and where institutions and banks are going to want to push the market. Because, like, let's say on a weekly right now, we have a wedge formation here, but we could potentially be seeing the Swiss franc coming back down to meet this low, because we're making lower highs and lower lows. So it's safe to say, to trade with the trend, that the Swiss franc can be coming down. just like it's safe to say with the yen's index, we're making lower highs but higher lows, and a breakout's bound to happen either way. And this is what I mean. So right here we have some sign of rejection at this area where we've seen price come into and then automatically get rejected. And when we hop down to the daily, we're seeing even more bullish sentiment that banks and institutions are wicking out this area and stopping price from moving past it. And we can see this with this macro M. And like I said, macro just means on a higher time frame. It's not going to be a 15-minute, it's not going to be a 30-minute. Most likely will never be at 1 hour. We're typically looking, or when I mention macro M's, I'm saying from the daily to the monthly. I will say macro M's when it comes to 4 hours because I get it from the daily. So we can see a clear macro M here. And even if we go to the line chart, we can see some sort of M formation going on there. And when we hop down to the 4 hour, we see even more conviction that it is not getting past this area. Let's see if we got any chats. What would you like me to repeat? Because I went over the mindset and I didn't record that, but I can repeat anything if you want. I mean, I got time. Might be, are you looking at the currency indexes? Was it something that I did technical analysis wise? This was 4 minutes ago. You still in here, buddy? Just a brief statement about sessions. Okay, so what I was saying about sessions is that during different sessions, you'll see the market doing different things. So with London session, we have the highest amount of liquidity. So the banks are moving the most amount of that $5.4 trillion daily that's moved in the market. Most of that money is going to be transferred during London session. And the lowest time of liquidity will be the Asian session, the Sydney session. And what will happen is banks will do something that's called a false move during Asian session. So what this means is they accumulate orders opposite of where they are pushing the market because they don't want us there. They want to trick us in any way possible because us winning money is taken away from their potential profits. Us winning money or losing money increases their potential profits. It means that they can fill more of their lot sizes with our opposite trades. Because for someone to buy, someone also needs to be selling. So for banks to sell off at this area, they also need a lot of buy volume at this area to match the orders that are going in. Because you can go on Kijiji right now and try to sell an iPhone, but if no one's buying, there's no transaction that's going to be made. So what they'll do during London session at the lowest time of liquidity, where all of the American investors, where we have our money sitting in the bank overnight, those banks are going to take our money, place it into the market, and then push the market opposite of what they want to do to fill orders just to drop it again. And this happens, the accumulation phase during the Asian session will happen from roughly 8 p.m. to 12 a.m. Eastern Standard Time. Then the London session, you'll be wanting to look for a potential buy or sell setup that goes against that false move. So let's say during Asian session from 8 to 12 a.m., let's say, what do we got here? What's first? Let's say US CAD during Asian session is moving bullish. During 2 to 4 a.m. When London session is about to happen, you'll be wanting to go bearish. You'll be looking for signs to go bearish when London session is about to happen. Now, this doesn't happen every day. This doesn't happen every week. But this is something to keep in mind when you're looking for trade setups, especially if you're up at Eastern Standard Time, 2 to 4 a.m., if you're waking up to trade London. I mean, this is also called the London Breakout. But pretty much this is something to keep in mind, that the banks have control no matter what you want in the market. They're going to push it to wherever they want the market. And that ties in perfectly with order blocks, because that's exactly what an order block is. It's exactly what it sounds. It's an area of orders that the institutions and the banks create. So I'll go to, I'll go to a GBP pair because they have high volume. So again, let's go to GBP USD. I mean, you can do this on every time frame. It's most effective on daily, weekly, monthly areas, but I've done it on 4 hours. With the lower time frames, you're looking more of what Gold Cup does, where they have a break retest, and that retest after the break will be on that order block. So if you're bullish and you see an order block and it breaks through that order block going up and it comes down to retest it, I would say buy and place your stop loss below that order block. So I'll find an order block here. And what an order block is, because I know a lot of you are like, you say order block, but you haven't said what it is. What an order block is example, in a bearish market. So for when the market is trending down and all you have are these red candles, an order block is the green candles. So let me delete this. Oh, fuck myself. So this green candle right here will be an order block. I mean, this is on a weekly scale. So you can mark out these weekly order blocks and label them and pull them across your graph. I mean, I'm not too sure if this has been respected. No, that was a very big high. So, and this is an example of order blocks that don't end up getting fulfilled. But I mean, on a monthly frame, when these because banks are trading monthly, they're trading weekly. They aren't messing around with the 4-hour stuff, but they do have traders within their institutions to do that for them. But when you are looking at this stuff, this right here, these two green blocks can be considered an order block. So we're trending downwards from July 2015 all the way down to October 2016. That's a long time to be trending in a bearish market. And on the swing back up this got respected 3 years after the fact. So this is how powerful banks are. They'll make an area where they want to push the market to just so they can sell off at that area 3 years later. I mean, that's fucking big dick energy. So this right here is your order block. This took me a while to figure out when I got taught it, but in a bearish market, your order blocks are going to be green. And you want to see them being respected before you trade them. But I mean, come on, guys. 3 years down the road to push the market to just to sell it off for what? Look at this. Because, like I said, these banks aren't messing with the small time frames. They're trading and holding these trades for years at a time. They're holding these trades for 3 years potentially before they end up fully liquidating their full trade. So it took 3 years after they pushed this market all the way down. It took 3 years back to rally back up. And they caught, after they broke out this order block, why is this not doing my graph? Okay. They're catching thousands of pips on the way down. And their other traders are, because they're pushing this market down from this order block, and their traders that are doing the 4-hour day trade in, the daily time frame trade in, they're catching all these pips on the way down while they still have those big orders sitting up here collecting these 1,600 pips. Imagine how much money a 1,000 lot 1,600 pip trade would get. I mean, that's how much these banks are doing. They're doing 1,000, 2,000, 3,000, 4,000, 5,000 lot trades over the span of 2-3 years for this to play out. This ended up taking just under a full year to meet this low. But I mean, just think about the money that they're making from doing this. And they're creating these zones so they can push it back to these levels at any point. So I will try and find, I believe gold has some good examples too. And like I said with the stuff before with the Asian session, this stuff isn't going to be tried and true every time. Just like how if you place a Fibonacci on a graph, if you just placed a sell at 61.8 because the market got to 61.8, excluding the Fibonacci strategy for US 30, you want to see signs of reversals. Pretty much these areas are for you to start building a case to trade with the trend to see if it's reversing. And like even right here, this right here is an order block. This right here is an order block. So let me delete that, get that out of the way. Is my markup kind of messing with you guys while I'm doing this? Or can I leave this on? Because I can remark it up, but if it's messing with your guys' learning, I'll take it off. Okay, perfect. So what this order block is, so we have a trend in market for over 200 days. We've had a bullish market. The craziest part is when I started trading was back here, and I watched this go all the way down, and I was sitting back here at 1,200. I was like, fuck, that's insane. Then all of a sudden when I started, I met Ben, I started trading with Ben back in February. Boom, February, right here. And I was trading by myself, demo, right in here. And I watched this market go all the way up. Then I've watched it come all the way back down. I've made trades right in here. I've made trades here. So it's crazy when you get time on a graph and you're able to look back and see gold move the way it has. And just think back, oh, fuck, how naive I was if I just placed a buy right here. If I knew the stuff back here, I could have caught, 12,000 pips. It's disgusting. That's fucking disgusting. That's some US 30 stuff. So yeah, back to what I was saying. If the market is bullish, you're going to be looking at the red candles for order blocks. If the market is bearish, you're going to be wanting to look at the green candle for order blocks. So for this example here, we can use actually on the way down, then on the way back up. So let's focus right here. So we have an order block right here. Let's drag that across, and I'll change this to, blue, just so it's a different color. So there's an order block. This right here, an order block. This right here, an order block. And when you're drawing out these order blocks, you want to be using the bodies because that's where the majority of all the orders went for that specific time frame. Now, if you're getting like a sliver of a body and some tiny shadows on each side for the wicks, use that whole thing. Like, I can't really find a good example right here, but if you got a really tiny, like didn't even move during that week, just kind of fluctuated in the same area, use that whole thing. But for these, you want to be using the bodies. And even for this one, use the body. And yeah, so we got 1, 2, 3 order blocks all the way down. You can mark this out might come to respect that area again, but this is kind of where you gotta use your own brain and kind of think, is this going to be used as an order block, or is this just the bottom and it's ranged? Because we got a clear W pattern right here on a very macro time frame. And that's kind of what signaled this whole move back up to this area that we're sitting at right now. So now that I've marked out these order blocks, you can see, I'll take this one off because I'm not fucking with that. So when you're trading with order blocks, it's mostly like in, hey, check out this area because shit's going to happen at this area. So as you see right here, for this order block, we can drop down to the daily. And it comes right to this order block. And remember, this order block is the weekly, so we're on the daily. It comes right to this order block and just ticks it. Just fucking tickles it. Then bounces and breaks right through. I mean, it takes some time. I mean, I can't really say that, oh, this is going to be a bounce breakthrough or a break retest. And that's where your due diligence and your whole training as a trader comes in. So with this order block, it comes, bounces off of it, and breaks right through. Comes to this next order block. And what does it do? It bounces and breaks right through. So you've kind of seen a pattern here. It comes to this order block, kind of tickles it, and then bounces and breaks right through. And even right here, it's bounced, come back. I mean, it's even rallied back. Check it on the daily. It's even rallied back, comes, rallies back, and breaks through. And this would be the break retest where you can get in for a buy. I mean, you're waiting for, what? God damn it. You're waiting for 2 weeks for this trade to set up. But then once it sets up, you can ride it out for 1 week and catch 3,000 pips. Or is that 338? I'm not too sure. But regardless, that's a big move to catch. And look, 4 consecutive days of being green. So when you're down on the 4 hour, I mean, you can even scalp it all the way up. Where would this trade? I mean, this one's fucking picture perfect for these 4 days. Where it goes, I don't know. For these 4 days that it just completely moves up. And even on the 4 hours, like, this is where support and resistance comes in. This is where order blocks, when you're trading this institutional style of trading, this is where you've pretty much congregate all your knowledge into what trading is. Because what banks want you to do is type into Google how to trade Forex. Look at those basic ass support and resistance. Because when you're trading Forex done by Google or YouTube, you're saying, okay, this is a resistance level. I want to see it come, break, and retest. But is that going to happen? Are the banks going to let you do this? And that's why they falsely move the market. That's why they manipulate it. We're playing a game that banks don't want us to play. That's the thing. So you need to use these tools that we're giving you, the education that even IML provides. If you aren't following Tim Trades on Instagram or Ty the God, follow them because they know what's up. And if you're in IML, send them a message. Get into their group. They do Zoom calls Tuesday and Thursday, and they even do them late at night unexpectedly during London session, and they give these institutional things. And this is where I've learned it. And these guys are no joke. Tim Trades, I'll give you a little background. He used to work for the Pentagon. He was trained as an attorney. He was trained to be to review policies for the government. So he knows firsthand how the government sets up our school system to train us to be workers, to train us to go on to Google and look up these things. So the banks and government can do exact opposite and manipulate us. And that's why they manipulate Asian session to make us small guys and us retail traders think that it's going bullish, but it's really going to go bearish. And especially with the financial market like this, do you think banks and governments want us making money? Do you think they want us to get rich from this stuff? No, they don't. They want us to be those middle-class workers stuck in poverty and middle class where they can use and abuse us. But when you're using the same tricks and tactics they use, like order blocks and this type of stuff that we're teaching you and that I'm going to try and be bringing to you, hopefully on a weekly. I mean, I'd love to be able to do this stuff weekly and give you guys breakdowns and everything and teach you this type of institutional style trading that I'm also learning. You're gonna see a big major improvement. And touching with, because I've went over what order blocks are, how to find them, and how to trade them. I believe I've went over how to trade them. You guys got any questions so far? I mean, am I going too fast? Am I getting off topic? Just kind of drop some feedback. Do you guys want to know anything? I mean, I only got 8 of you guys in here. We were up to 11 or 12 at one point. Probably bored them with my talking, but I just want to give you guys the most value out of this. But quick recap, I've went over currency indexes. If you guys want to know more on how I'm using that to gauge trades, I can definitely go over that more. If you want to know some trades I'm looking at, I mean, I've kind of posted them in the admin watch list. This is pretty much going to be huge for me. I'm really going to be utilizing this to give you guys the most value. Like, I'm doing full write-ups to kind of get you guys inside my head how I'm looking at this. And I mean, you 8 that are in here now and potentially 11 at max of what we had, you guys are going to be getting the most value out of this watch list because I've now shown you exactly what I'm looking at, exactly how I've seen this and spotted this. So when gold is now making its hopefully bearish move down, you guys will be able to see what I mean by it is going to be coming down to this order block here. And look how well respected this order block has been. And this is on a weekly time frame. So has it been respected back here? Was there another order block? No. So this order block right here, good respect. False breakout to trap retail traders, then right back up. Then we break out and retest. Look at that. I mean, this shit is literally exactly what I just went over here. And then come back up and then break out and retest. I mean, the banks are going to do what they want, but these zones definitely give you a big insight into how they're moving this market and what their general outlook's going to be. So what I'm now looking for is I'm looking for gold to come back down and then bounce back up to meet with this high. I mean, it kind of correlates with an order block. I'll take you right through this. Let's go to the monthly. Let's fucking break this down. Because, I mean, look at this shit. I didn't even know this shit. What is this right here? In a bearish market, each green candle is going to be an order block. So looking right here, we got this order block that gets respected, gets wicked out, and then drops back. Now, what I'm looking for is it to come break through this again and come back to meet this, to finish the right shoulder of this head and shoulders. To maybe drop down to this area, meet this monthly trend line. Who knows what's going to happen after this right shoulder, but this is my general outlook of what I'm expecting to happen over the next half a year, 6 months, 7 months. I mean, this really gives a huge outlook on where the market can be going. And this is where you guys want to be looking. This top-down analysis. This is where you want to start. You want to start at the highest level and break it down. Because if you're selling in a bull market, especially on a monthly, a weekly, and a daily bull market, why are you selling on the 4-hour? I mean, it seems silly unless you're doing a short, quick scalp. But even still, if you're trading a bull market, you want to be doing buys. If you're trading a bear market, you want to be looking at sells. You don't want to be going against the trend. And this is where the banks want you to do. This is what they want you to do. They'll manipulate the market. So in a bull market, because they know most traders are looking at the 15, the 5, and the 1 hour, because they don't like waiting as long as they do for the 4 hour or the daily or the weekly. Fuck, even the monthly. No one wants to wait a month to see how a candle closes, but it can sure fucking tell you a lot. I can tell you that. I mean, even at the weekly, what I mentioned in my admin watch list, every time this market, gold, has stepped into this range, almost every time we have seen a bullish engulfing happen right after. Steps into this zone, closes, bullish engulfing. Steps into this zone, doesn't close in this zone, bullish engulfing. And they're always followed by a nice trend down. So come over here, bullish engulfing, bullish engulfing. I mean, it's patterns on a high time scale where you guys want to be looking at. So how long do you put into a sell and let that sit? That's definitely a more personal outlook. Like currently I'm using these higher time frames to gauge where the market's going. So I'm expecting to see this week be very bullish or very bearish, because we've now stepped into the zone, and I'm now looking for bearish engulfing candle to close to signal that we've now entered into a bear market. Because just like I said, for the past, how long has it been? The past 5 years have, besides this is an exception, but this is a fucking huge macro M, if you guys can't spot this. I mean, you got your one high, you make your low, then you got your next drive up to a huge sell-off. And even respects this order block that was established right here. It drops below, breaks, retest, and continues down to this trend line. But this is a macro as fuck M. So this is stuff that you want to be looking at. Because if we close this week as a bullish engulfing, that almost signals 100% that we're going to be stepping into a bearish market all the way down to meet these order blocks, to fulfill these order zones. So how would you pretty much scalp it the way down? So the way that I'll be personally doing it is you're going to be wanting to look for, in this case, since we'll be stepping into a bearish market, you want to be looking at bear flags, where the market shows signs of letting up. Let me scroll over here. So over here, we get the bearish engulfing, this macro M. We know that we're stepping into a major bear market. So on these pullbacks, you can, this is where my trainings kind of come into a bit more, is I'll be using bounce back and the training that Stevenson Lindor has talked about on his IML lives, on his Facebook group. If you aren't in the bounce back Facebook group, there is nuggets upon nuggets of gold on how that man trades. And that man is very, very good. He's an educator for a reason, because this man is good. And this is exactly what he does, is he looks at the whole macro perspective and he trades with the trend. The trend is your friend. You'll hear this a lot of times in the trading world. The trend is your friend. Because why do you want to be buying when you should be selling? When the banks are selling, you don't want to be buying. And that's what they'll make you think. So the banks will go push this market down. And this right here is their accumulation zone. This is where they trap retail traders into thinking, oh, hey, market's reversing. Look at this nice push up that we have. But what a lot of retail traders aren't going to see is the signs of this whole macro trend, one, and two, that this is just an accumulation zone for the banks to fulfill their orders so they can drop a fucking 5,000 lot trade right here to drop this down. I mean, in 4 hours, it dropped from 1310 all the way down to 1297. That's like $20 in price in 4 hours that it just falls out of the sky. You had another 4 hours, a full day of work, and you've now watched gold drop from 1310 all the way down to 1290. $30 drop in 8 hours. In the micro perspective of trading and micro perspective of gold's price, this is fucking huge. But now if you were trading with the banks and you had to sell at the top trend line of this flag, and it's going to take some back testing, it's going to take some live testing of seeing this, you'd be looking at selling, taking some sells at these highs. You didn't get your break here, but it comes, rallies up. Let's say you're already in a trade here. Place an under leveraged trade here, because you know on the whole macro perspective of things, you're in a bear market. So you don't want to be buying. I mean, look at how big those 4 hour candles looked. But on the whole macro perspective, look at how small that is. Look at how small those trend lines are. Look at how small the body of that candle is. And this is what I mean. This is where they trap traders. This is where they manipulate us. Because, I mean, yeah, more experienced traders are going to look at this market and be like, okay, well, we're showing signs of potentially a bigger push to the downside. But this takes years to look at a 4 hour chart and be like, oh, hey, look, I mean, you can only zoom out so far on this. So you're looking at this data, and I mean, the whole perspective of trying to scalp this down is finding the macro trend. So we've identified the macro trend. We have a macro W. We've finished the weekly off on a good note, considering all we're looking for is bearish engulfings. So, I mean, we didn't get the bearish engulfing here, but we've now stepped into this quadruple top of equal highs. And now this is where I'm going to tell you guys about institutional levels, because this comes into a major play. I'll teach you on the Forex pairs, because this is where you'll spot it easiest. But on things like gold and US 30, it's going to take some time to find these. But let's say we'll go to everyone's favorite, US versus yen. So institutional levels, I want you guys to write this down. I'll put it in the chat. Institutional levels are 00, 000, 20, 40, 50, 60, 80. So these are institutional levels, and I'll show you exactly what I mean. Do I have anything pair-wise? US 30, GBP. Yes, I was looking at US dollar yen. I had a bullish outlook on this, I believe. Or no, that's GBP yen, right? Okay, but regardless. So let's go to GBP yen. I mean, I have this area marked out. I'll kind of tell you guys about this. This is the key area that I'm looking at. I don't really think that it's going to be holding up right now, but that's actually just going to get a little side note. So, I mean, this right here, what do we see right here in order block? Bam. Pop up to the 4 hour. Any order blocks? Nope. Any order blocks back here? Nope, that's low. So, I mean, this is a super, super duper bearish market. And what I mean by these institutional levels is I'll go into the black space. So triple zeros, double zeros, And with that, you want to be seeing the 20s, the 20 level. So this would be a 200, a 400, 500, 600, 800, and those 1,000 level marks. We'll go to a non-yen pairing, and I'll show you the same thing. So the double zeros were 40, 50, 60. The triple zeros, the 2600s, the 2700s, the triple zeros, the double zeros, and specifically the 20s, the 40s, the 50s, the 60s, the 80s, then the triples. You'll also hear this being called quarter theory, and this is what I used to call it. And quarter theory kind of goes by a 50 pip basis, where if you place the trend line on every 50 pip, you'll see the market act a certain way at that level. But how we implement these institutional levels is, again, we go to the macro. You want to be identifying the macro trend of things. And I'll use my example on gold because that's kind of what we're talking about right now. Is I had macro institutional levels at 1350, 1360. We came up just shy of hitting 1360. I actually had placed a buy at 1339, which some traders would think is ridiculous because look at this trend. You want to be trying to catch that reversal. Most retail traders will think of that. But I traded it right back here, and I bought this high at 1339 area. And I mean, I've been looking at a bounce back trade for this, so I'm actually looking for a huge sell. But put in my institutional levels at work, knowing that we aren't fully done exhausting that week. We still had 2 days left in the week, maybe 3 days. I placed a buy back here. And almost immediately, I woke up the next day in 20, 30 pips profit. I cut it because I cut it at, I believe, 1342. And I cut it because I was already happy. But my main target was 1350. And I placed it in my text and group chat with Ben and a few other people. And no one really commented on it, but I just kind of told people what I'm doing. But my target was 1350. Kaija, who uses, I believe that's his name. It's spelled weird. Looks like Kyle said differently, but he uses harmonic pitchforks and stuff like that. And he had a sell stop placed at 1350. And I mean, if you took that sell stop, you're well into profit now. But my other institutional zone, my take profit too, was this 1360 area. We had a high of, I think, 58, maybe 57. I think it just touches 58 there. But where I seen that was going to the macro. You always want to start tall, go short. Start on the daily, the weekly, the monthly, and bring it down to the 4 hour, the 1 hour. I mean, if you're more of an intraday to a swing trader, you're going to be looking at the 1 and 4 hour for these institutional zones. But you want to find them on the daily and the weekly. And I mean, still speaking with this huge liquidity zone that institutions have created back here, is you see this high at 1360 kind of being respected all the way back here, especially right here. This is where I was almost like, okay, 1360 is 100% an institutional zone because they don't want to push it past that. They had it here, but look at this massive sell-off they had afterwards. They didn't like it getting past that, so they had to drop some huge lots back here to keep pushing it down. And the 1350 area, I mean, you'll see these institutional levels. This takes time to spot, but you'll see these institutional levels be wicked at or stop right before. Because if you were, let's say, driving down the highway, you're doing 20 over. If you get seen by a cop, you're going to get a ticket. If you see that cop, are you going to slow down right at that, where that cop is, or are you going to start to slow down right before? And this is what these wicks are. This is them slowing down right before to push that market right back down. These are the areas that they want to see the market go to so they can start pushing it right back down. or this is the areas that they're pushing it up to. And again, this ties in with the order blocks. The banks and institutions want to push it to these levels. They create these levels of liquidity. And what liquidity is a third party taking on risk. So an area of liquidity is an area where people take on risk, especially on a large scale where banks, institutions, hedge funds, they want to take on these risks, because if you were trading $1 billion portfolio that wasn't yours, are you going to be placing a sell or a buy right in here? Or if you had enough push and pull in the market, would you want to be placing a buy right here? No, you're going to be wanting to place in sells. So these institutional levels are something you need to be putting on your radar. And again, they're the 00, 000, 20, 40, 50, 60, 80. Those are the areas. And with that, we've seen the 50, the 60. Yeah, I mean, you can get very micro. And let's say, this is in my way. You can get very micro and say 13, 50, 80 was respected as an institutional level. And I mean, would you be lying if you said 13, 50, 80 was an institutional level? No, you wouldn't be. That's a very respected level. But on macro things, I mean, you're kind of taking a shot in the dark when you're placing a level on a 15. So this is why I say you want to start high, go low. Start top-down analysis with everything. And again, tying into this whole Zoom call is you want to be starting your analysis on these indexes. Because looking at JPY, the yen currency index, the JXY, we're looking at potentially a huge bearish sentiment entering the market. A huge bearish sentiment enter in the market because we have this wedge. I mean, this is where technicals come in. This is where looking over all the education in this new education tab is. We have market structure. You want to learn these. You want to see exactly what each one of these structures mean. And even if this doesn't get respected as a symmetrical triangle, which it is, it stepped into this descendant, made a symmetrical triangle, and now we're potentially looking at this is a bilateral pattern. So this can go either way. So that's kind of why I have it going either way, because we're just squeezing price, and at some point one area is going to break. And I'm thinking we'll break to the upside because of my technicals on a huge scale USD JPY analysis, where over the next 10 years, I can see it coming up to the 150, 200 areas. This chart doesn't go all the way back to the 60s, where I believe it started to get traded at, but huge time frame where I believe USD JPY is going to be taking a huge step forward into a bullish trend. And yeah, so back to top down, you want to be starting your analysis on these currency indexes. And if the currency index is kind of chip choppy, you can't really make sense of it, you can still trade these, but trade them with more caution. You want to make, like with Euro, the EXY, it's in kind of this bullet or bearish move. I mean, where it's going to stop, no one really knows. We're kind of in this area of where stuff tends to kind of reverse. We could be seeing the EXY come all the way down to meet these lows. We don't really know, but as of right now, on a weekly and a daily and a monthly time frame, we can clearly see that it's making lower highs and lower lows, trending downwards. Lower highs and lower lows, trending downwards. So safe to say that if you took a bearish trade on any euro-based pairs, so let's say Euro USD, I think it would be safe to say that you can then look at the whole as trending bearish. And I mean, look at this right here. Does this not just look like the graph that we were just looking at? I mean, look at this, and now look at that. almost fucking identical. But now that was Euro USD that we were looking at. Now we go to the DXY. And what's the DXY doing? It's bullish. So taking a sell where the US dollar is getting strong and the euro is getting weak, taking a sell on Euro USD seems very likely that it's going to go in your favor. Overall, in a bearish trend where the euro index is bearish and the dollar index is bullish, because if the dollar strengthens, euro goes down. If the euro decreases, the euro goes down, and vice versa. If the dollar is weakening, you'll likely see the euro USD pair. If the dollar is getting weak, that means euro is going to be getting strong against the dollar, and you'll see price rise. And this starts all at the top-down analysis. I mean, I think I've kind of beat these concepts into you guys. Is there anything you want me to go over? Is there any pairs? I was going to try and keep this an hour. We went about 15 over. So, I mean, is there anything you guys want me to go over? For the recording that I'll be putting up on YouTube, like I said, I started it with currency indexes and went into order blocks. I'll probably just put the whole meat of this on YouTube. So it'll probably be about an hour-long video that's going on YouTube. If you guys have notes to go with this, very much appreciate you guys sending that to me so I can put it in with the video I'll be posting in the education section somewhere. Like I said, I want to be trying to do this weekly. I want to be trying to do this weekly with you guys. I'm going to be tuning into a lot more institutional trading training, so I'll be able to relay some more of these concepts with you. I'll be able to go over some more stuff. We'll be able to actually see these trades on a weekly scale pan out. Right now, my watch list includes a sell on gold. I'm looking at the US 30 going down. I'm looking at USD JPY to get strong, so bullish. So taking a buy on US JPY. Actually, let's check that. I haven't checked that today. Didn't really realize that the market's opened. So, I mean, this is almost picture perfect. We're looking at, we can close today off at a very strong candle, which then will help complete this W. And yeah, if we get a nice strong close at the end of the week too for this candle, I almost want to say I want to take a trade on this. I haven't done enough analysis yet though. I don't really see any questions or pairs popping up into the chat that you guys want me to go over. So right now I'm just going to kind of run you through what I'm waiting for to hop into USD JPY. So like I said, on a macro scale, we're looking at the USD JPY to be going back up to this area towards the trend line, which might yield a 300 pip swing trade at its fullest, if that's one position. And like I said, you can be taking multiple on the way up, and then potentially multiple on the way back down for another 200 pips. But currently what I'm going to be looking at, this is going to be following bounce back rules because we have a trend in market. So right now I'm looking at this trend line to break according to the MACD. So right here, give you a little training on how I see this MACD, is we've now crossed the zero, which means we've had a trend change, which then aligns with our W formation that we've identified on a macro scale. And we've now looking at this kind of bounce where it's not really going past zero yet. I know it's kind of went past zero, but it looks to be as if it's recovering back into the bullish areas, the higher parts of this MACD. But the rules of bounce back are identify a trend, place that trend line, hop down 1 or 2 MetaTrader 4 time frames. So that was on the 4-hour, and I'm hopping down to the 1-hour now. So I will now from here tune my trend line, and I want to be catching these because you want to catch the overall trend. You don't want to be catching this because that's not a full trend line. You don't want to be catching, let's delete that. You don't want to be just saying, oh, hey, look at this. Boom, we've had a break. No, because that's not the whole perspective. Yes, this can still yield you pips when you're using this strategy, but that's not the whole outlook that bounce back is. Because bounce back is a reversal strategy. So you want to be catching the whole trend to confirm that the reversal has taken place. So I've now identified this trend. I've hopped down 1 time frame. And considering this trend is still very visible on the 1 hour, I can now hop down to either the 30 or the 15 and wait for 2 things to happen. We're waiting for price to break this trend line and the MACD to cross the 0 line. Now, if price breaks this trend line, closes a candle above the trend line while the MACD is above, like this MACD stays trending above the 0, I would say that validates a buy. I mean, I almost want to take a buy now, but we can sure clearly see, I mean, not clearly, but we can sure see the markets take a turn for the worse and head back down. And this area just be a bounce retest. And this is why I like bounce back a lot, because it pretty much gives you an easy confirmation checklist that now allows you to catch these reversals. And I mean, even if you didn't see this whole thing that's going on the weekly scale, and you didn't see this whole thing, and you didn't analyze this JXY and DXY, but you've seen that there's a trend in market right here, and it's making higher or lower highs, lower lows, and it looks to be reversing, and we're waiting for this break, you can still catch this all the way up. I mean, you can even go as far as taking a fib, going to the top, to the bottom, and once we break this area, you can then place a take profit 38.2 at 50, 61.8, however you want to utilize your fibs. But this is essentially what bounce back is. Not essentially, this is what bounce back is. You identify a trend, you place the trend line to catch the whole trend. You don't want any breaks. You don't want it to look like this. You don't want to look like that. You don't want it to catch just half of the trend because that looks better and that will place your trade sooner. No, you want to catch the whole overall trend, and you want 2 confirmations, price to break and MACD to cross. These don't have to happen simultaneously. You can have the price break, but MACD is still below 0. So you're waiting on the MACD to cross 0 before you hop into the trade. That's perfectly fine. As soon as that MACD crosses 0 and price is above the trend line, you want to be placing that trade. Now, if the MACD crosses in this case and price breaks after, still validates the trade. Take that trade. But this is also where top-down analysis comes in, because you're now looking at a macro time frame. You're looking at this area of interest. You're looking at this trend line. You're looking at this trend line. Now you can safely assume that after this reverses, you can have a high back up to here. I mean, I'll do it right here. I'll hop down and I'll look at this just to show you how bounce back works. So we're taking our trend line from here and taking this whole trend. We'll hop down to the 1 hour. Find this motherfucker. Okay, now we've captured this whole trend. Yes, we get the break here. And yes, this would be drawdown. But this is just part of the game that we play. So if this happens, Your stop loss would have been hit. Your stop loss would have been there. You would have lost out on, unfortunately, 30 pips. But now this has created a new trend line for you to follow. And then price comes back, hits this, and then you get this whole reversal back up. But that's on a swing time frame. What bounce back is good for is 20 to 30 pips. So I didn't even hop down a full time frame. So let's do that. Now this is going to take a little longer to find, but. And again, if you guys got anything you want me to go over, anything that you want me to analyze, please do let me know. Oh, that's not even gonna let me go back, motherfucker. Will it let me go back here? Okay, perfect. So this is our trend line. So right here, we're seeing this break of the trend line. And then we see the break of the trend line, and we already have MACD crossed. And typically, if it's a 1 hour signal, I'm looking at the 15 to get in nice after this break. And I mean, 20 to 30 pips, you get 10. And like I said, you can get 10 there. And I'm using the shittiest example. But tell me if you want me to go over anything, please. I'm going to be wrapping up this call. I'm going to stop recording so my computer's not